Good afternoon. Welcome to Gambling with an Edge. I'm Bob Dancer.
And I'm Richard Munchkin.
Our guest today is mathematician, sports analyst, and prolific writer, William Ziemba. Bill Ziemba, welcome to Gambling with an Edge.
Thank you.
How did you get into sports betting analysis?
One thing I did yesterday is I wrote out some written response to your questions. So what I'll do is I'll read those and then we can elaborate a little more. How did I get into sports betting? I was always interested in sports. I played basketball, baseball, football when I was a kid. And I went to horse racing, Saratoga Racetrack, and so forth. One thing I mentioned is later on I was a member of the Oslo Rugby Club when I was had a summer job in Oslo. I was a big fan of Ted Williams when I grew up. He had the same birthday as me, and now I'm a big fan of Warren Buffett. We all have the same birthday. So it's just another financial market to watch and bet. So it's kind of fun on the sports to watch them and bet on them as well. And it's a good subject now because there's so much interest in it at the moment. And the analysis that we do from financial markets is very similar in a way as well. McLean and I are finishing a book called Sports Analytics, where we do all sorts of sports. We do strategies, and then we do the betting. I do the betting. He helps with the strategies.
All right. We're going to talk about that book later today. Most of our listeners revere Ed Thorpe for his blackjack book, Beat the Dealer. How does he figure into sports betting?
Well, first of all, Ed is not actually interested that much in sports. He's a runner himself, but so forth. I know Ed from his 1971 Kelly Criteria paper, which I reprinted in my book, Stochastic Optimization Models in Finance, 1975. Ed was the first academic who was really interested in Kelly betting, and he used it in his blackjack system. That way you maximize long-run wealth most, but not all of the time. It's a good strategy, but it's risky short-term, but it's good long-term. The bets are aggressive, and the wealth path can be rocky, but long-term, the final wealth is usually large. And we use the same ideas in sports betting as well. Now, various people use this in the stock market as well. I taught this to Jim Simons, head of Renaissance Medallion, the very top hedge fund. In my calculations, the second best hedge fund ever, pretty well, was Thorpe. And I have a nice paper on describing them in the book, Great Investment Ideas, if people will want to look at that book. So Ed was instrumental in pushing the case for Kelly investing. We have a handbook that he and I did together with McLean called the Handbook of the Kelly Investment Criteria, which has the mathematical papers and some of the practice of it. And in the practice of that, you can find the practice of Kelly in Great Investment Ideas book.
While we're talking about Ed, you came up with a method of beating horse racing in the 80s, and Ed was the one you called to sort of go in with you to, he was the one basically who...
What actually happened, well, first of all, let me just explain the idea of the system. Win bets at the racetrack are essentially efficient. There's a bit of a bias called the favorite long shot bias, but essentially the odds for win at the racetrack by the bettors is fairly correct. So you can use those probabilities to price more complicated bets. Initially, in our Beat the Racetrack books, they're all on Amazon and so forth. You can find them there. What they do is they price, place, and show bets, which are more complicated, and then we use Kelly criteria to figure out the bet size. So that was that sort of stuff. So what happened was Ed wrote the foreword for the book Beat the Racetrack, because remember he had written Beat the Dealer and then Beat the Market. He had two books, so we did Beat the Racetrack. And what Ed nicely said was, this is one of the gambling systems ever devised that actually works. So it's kind of a simple system. You watch the prices. Later, what we did is I worked for some of the hedge fund syndicates in Hong Kong and Australia. And they do professional betting at a large scale, huge scale, betting millions. And that's very successful. And what you do is pricing the bets is crucial to the thing. There's handicapping, and then there's pricing the bets. Basically, what you want to do is bet on the things where you have an edge, like what you say here, gambling with an edge, et cetera. So that's sort of how that works. And Ed was instrumental in backing the system back in 1984. And then I took him to the first Breeders' Cup at Hollywood Park in 1984, and we tested out the system there. And there's a write-up about that. And there's a chapter in the new book, Sports Analytics. Sports Analytics is basically done, except it's going to take 2 or 3 months for the publisher to get it out. And in there we do lots of sports, and we can do a lot of stuff on racing. And we have the write-up of the day that we took Thorpe to the Breeders' Cup.
So related to racing, at least one other name that is familiar to our listeners, Bill Benter, who's in the Blackjack Hall of Fame.
Well, Bill Benter was the girl. And Hoss and I helped him early on. That was, and I met him in the 1993 in Phoenix for an operations research conference, and he wrote a paper in our book, Efficiency of Racetrack Betting Markets, which that's the Bible for the Hong Kong racing teams. And what Benter did was two things. He actually looked at the prices, and it took him a while to start winning, but then he got a system together well, and he was very successful. And what he did is he actually made it work in Hong Kong. In the early days, you could get into the odds pools every 12 seconds. So that was a big advantage that they had. And you had computerized betting, and he was very, very successful. It's extremely good. The main paper that he wrote is in our book, Efficiency of Racetrack Betting Markets. The original copies were expensive. Some sold for $10,000 on eBay, but there's a $80 one that's available. Now I did a second edition. So that's Efficiency of Racetrack Betting Markets. You'll find Benter's paper in there. And he was a very successful guy, and he's still active in the business. I was the expert witness in a court case of one of the fellows who worked with him, created his own team later. So I did that in Hong Kong the last few years.
Would that have been Alan Woods?
No. Woods I never met. He has one paper in one of my books, But no, it's another group that basically, well, it's a kind of a complicated story. What happened was, this was a guy who worked with Betfair for 15 years. He knew the horses well. He was not Chinese. He hired a whole bunch of Chinese masters in statistics students, and they created a new model. But they also hired a statistician, Chinese statistician, and he developed a better model. And in his model, basically, the Chinese statistician basically stole the model. And the court case was about proving that he stole the model. And what was interesting, there was the partnership they had their model, and then the Chinese guy had his model. And it was a very interesting consulting job to do this. And what we found out was that the Chinese model was essentially a levered version of the other model. And it had 8 years of data of all the bets, a lot of bets, huge amounts of bets. And it was a complicated case. And it shows how vulnerable people are to crooks in the world we're living in. There's lots of crooks these days. They're everywhere, especially in the United States, and so forth. So anyway, that was an interesting case of working on it, so forth. But Benter's role in that was just to recommend me as a expert witness. So he wasn't officially involved in it. It was these other people.
All right, changing subjects. What is risk arbitrage?
Now, regular arbitrage is buy gold in New York for so much and ship it to Pakistan for 2 times the price. So the regular arbitrage is to buy and sell the same thing for different prices. Now, regular arbitrage does exist quite a bit, and you can construct them. But what exists more is risk arbitrage. Now, risk arbitrage is actually what Thorpe did in his fund, in his Princeton Newport fund. So he did this with warrants. Now, I discovered risk arbitrage sort of independently of Thorpe. I went to Mexico City in 1982. I was consulting for the Canadian Sports Pool. We were designing sports games, lottery games based on sports, baseball, football, etc. Now, when we went there, we went to the High Lie, and in the High Lie, they have betting on the game throughout the whole way. So that's how I discovered risk arbitrage. Risk arbitrage, you make an initial bet on, say, Team A, and then you want to bet on Team B later at a better price. But let me give you the example I like the best. The example I like the best is the last Super Bowl. As you know, Tom Brady got into the Super Bowl, and it was against Kansas City. Kansas City was favored. Mahomes had won MVP the previous year, and Brady had won a whole bunch of years, etc. So you would assume that one of those two would be the MVP of the game if whoever won the game. But the interesting bet was on Gronkowski. Gronkowski was brought in by Brady from New England, and he had retired. And he was used very little during the whole year and very little in playoffs. But he holds the records for the most amount of TDs in Super Bowl history for a tight end. So you would make the assumption that Brady might rely on his reliable guy. So the odds that Gronk would be the MVP were 188 to 1. So you could get 180 to 1 to do that. Now, you know that he's not gonna actually be the MVP, but what you want is to get some 188 to 1 and then exit the trade later at a lower price. So the first TD went to Gronk, so the odds of 188 dropped a whole bunch. And then the second TD went to Gronk, and then the odds were 6 to 1. So what it was is you could cover at 6 to 1 and get out of the trade.
Wait, how do you bet the other side of? Oh, are you using Betfair where you can bet either side?
This was Betfair.
Okay.
So you basically bought at 188 to 1, and then you sold at 6 to 1. So you're 182 ahead times the amount that you bet, say 100. That would be give you 1,820 profit, and so forth. So that's a good arbitrage. Now that's the kind of stuff we use in NFL football, and I've just done the NBA finals, which were good. Risk arbitrage. So the way it works in the basketball game is you go long one team. Say it's Milwaukee. Okay, so you go Milwaukee, and then what you try to do is cover the other side at a better price. Now, when you get a better price, if Milwaukee gets way ahead, then the other team is longer odds, so you then get the other team, etc. Now, in basketball, you get about 20 of these changes per game. You get them all the time. So anyway, on the risk arbitrage, it works quite well in NFL football. In the Dr. Z's NFL guidebook, I do 10 years of betting there because you get an awful lot of these risk arbitrages especially in the fourth quarter. And then in the new book, McLean and Ziemba Sports Analytics, there's 3 more years of NFL. And then
I would think this.
Go ahead.
I would think this would work really well in political elections.
It has. I've actually bet on the 2024 election. So
already? Oh wow.
Yeah. Well, there's one complication on Betfair. When you make a bet for 2024, they won't settle the bet till then. Okay. So the first thing that you know about the arbitrage stuff is if you go for the president of the United States, who will be president? At the moment, the odds are Biden about 6 to 1, Harris about 6 to 1, Trump was around 14 to 1, and some of the other Republicans are higher things. So here's the bet I made. First of all, if you short 25 of them, which is basically what I did, you actually win on 24 because there's only one person who can be president. Okay? So I don't know how it's going to turn out with Trump. We all know that he's a slippery crook, but he's been able to evade he's always in trouble, but they never actually pin anything. So it's really hard to tell how it's going to turn out, whether they're going to do something legally against him or something. There's a lot of stuff going on, etc. So I'm short Trump, and I'm short the guy in Florida, and I'm short a whole bunch of the Republicans. I'm also short a whole bunch of the Democrats, who I don't think will win, so forth. Now, one nice thing about the way the betting works on Betfair is when you short someone, you have to use up margin, the margin of the money you have. But then when you short somebody else, you collect a bit of the fee. So let's suppose I short Trump for 400, which is what I did. Okay, so that means about 4,000 of margin. And then when I short other people, say for 50 pounds or so, then I collect 50 pounds. So I get back some of the margin. So that's a way of doing that. Now, the nice thing about this kind of betting is you short the ones you think are going to lose, and you don't go long the things you think are going to win. So more than likely at the moment, either Biden or Harris would be the next president. But we don't know. That's several years from now, et cetera. So in these kind of bets, it's actually optimal to do shorting of a lot of them and not going long the so-called ones with an advantage, because what you really want is to win all the shorts and then have one of the ones that was the winner type, that's Biden or Harris in this case, actually win the election. And then you win all of them. So, and I have about 25 short. So that's one way of doing that, of betting on that kind of thing. That's kind of a certain type of risk arbitrage. The standard risk arbitrage is kind of a football game. So you're like Tampa Bay against Kansas City, which one will win, etc. So that's the thing. By the way, there's a whole full write-up of that game in the sports analytics book. What McLean and I do is we write up these football games, these seasons, and then we put them in the books, and also in Wilmot magazine.
Unfortunately for our listeners, most of our listeners are in the United States and don't have access to a betting exchange.
Well, there is a way, if you want to be a little bit shady, if you want to be a little bit shady, what you do is you get a VPN, and that will hook you into London. And that, and
you need a beard as well, because you need a beard as well, because they won't accept you as a U.S. customer, so you need somebody, in London. But anyway, yes, it can be done, and our sharper listeners are already doing it.
You're right. You need someone in London who has some kind of utility bill, some friend of yours or something. So that's right. Now, the sports is moving into the U.S. though, in terms of more states, and they're talking about moving it into Canada as well. So in future there'll probably be more of this.
Yeah.
Very good. Now, your system for betting the NFL relies on efficient sports betting market.
Oh, well, okay, first there's two things. The odds that are set by Las Vegas. So you'll find a game and it'll say Kansas City is favored by 3 points. There are formulas to translate the 3 points into probability that each team will win. We have those formulas in our book, the Dr. Z's NFL guidebook. You can find formulas in there. Now, you'll also find in there a chapter where we actually looked at the odds and see, are they actually efficient, like an efficient stock market? And the answer is they are. So more or less, the Las Vegas odds are very accurate. So the only way you can win is to have superior information. Like, for example, is Aaron Rodgers really going to play for Green Bay this year, or is he not? Or so forth, So if you have superior information on some player who's key, that could be the case. Or the other way, which is the way I do it, is the risk arbitrage. So you will make a bet on team A and then try to make a bet on team B so that you have a arbitrage. And the formula is if you multiply the odds on A times the odds on B, if that's greater than 1, you have an arbitrage. Now, there's British odds and U.S. odds. With British odds, you bet you bet 1, and the odds are 3-1. If you win, you collect 3. In U.S. odds, if you bet 1 to collect 3, the odds are 2-1. I'm sorry, I'm being a little bit sloppy here. So the U.S. odds are the British odds -1. So that's how you work the formulas. And I have a tutorial in the sports analytics book. Probably 2 months for that one to come out. We're basically done, and it just depends how long the publisher needs to print it. World Scientific is doing it.
All right. We are now going to take a brief break for a commercial message. We'll be back.
Good. Okay. Very good, guys.
With William Ziemba talking about getting an advantage at sports betting and betting the market. The South Point has more than 10,000 games returning at least 99%. This is more than anyone else has. In August, play $1,800 slots of video poker Monday through Thursday and pick up a free logo gift celebrating the South Point 400 stock car race. Week 2 is coming up. It's a unisex pullover. And week 3 is a Yeti tumbler. If you earn and pick up all 4 gifts, you receive $100 in free play. Although the gifts are better than average for casino gifts, the Yeti tumbler, for example, retails for about $30. Even if you value them as being worth 0, earning and collecting all of them is worth an additional 1.4%. For locals, there's a Play X and Earn Y promotion every Friday and Saturday. If they have your email address. If you haven't given them your email address yet, you can do it online at southpointcasino.com/club, and you can be eligible for this promotion. If you do it by any Tuesday, you'll be eligible for the following weekend and each subsequent weekend of the month. On Sunday, September 26th, the South Point 400 NASCAR Cup race at the Las Vegas Motor Speedway. Tickets are half price at the casino box office if you use your points.
Hey guys, this is Colin from blackjackapprenticeship.com, and if you're serious about card counting, I'd encourage you to check out the Blackjack Apprenticeship membership. It has the training tools you'll need to beat the game, like our comprehensive video course and our training suite, so you can learn each skill and virtually test yourself before ever stepping foot in a casino. It also includes the tools you'll need to succeed, like our pro betting software, casino database, results tracking software, and access to a community of like-minded Advantage players to network with in our members forum and chat room software. You can find out more at blackjackapprenticeship.com.
Videopoker.com is the best place to play lots of games. If you sign up for the Gold membership, $8.95 a month or $79.95 a year, this allows you to get correction on most of the games. The game of the week is Triple Triple Bonus Poker. This is an ultra-high variance game. It's similar to Triple Double Bonus in that you get paid $800 for 1 for all aces with a 2, 3, or 4 kicker. But this time you also get $800 for 1 for alls, 2s, 3s, and 4s with an ace kicker. This is an additional $400 for 1 over Triple Double Bonus, and it occurs approximately every 13,000 hands. To pay for this, straights are reduced from paying 4-for-1 to 3-for-1, which cost a bit more than 1%, because straights come about approximately 1 in 97 hands in this game. The variance is around 140, which will make you wish you stayed home if you don't hit one of the big ones today. All right, we're back talking to William Ziemba. And you talked about Betfair, and you made a comment somewhere that the Betfair charges inefficiently. So what does that mean, and how can players take advantage of it?
There's two parts to this. The first part is, even though they have a flawed system for collecting fees, they still make billions because there's so much betting. The volume is incredible. Now, the flaw is the usual situation on various bets is if you bet like on 100, you get charged a part of the 100. Now, in Betfair, you can bet 100, 200, 400, 600, etc., on a whole bunch of bets on the same thing. And in total, you bet 1,000. And you wind up winning 25 pounds. They charge a commission on the 25 pounds, not on the 1,000. So they got into trouble a couple of years ago with bookmakers who came into their business and took a lot of their business away because they could undercut them with lower fees and also do it the regular way, where you take a cut of the thing. So the business, some of the business is taken away, but their business is unbelievable. They're betting on almost anything you can think of, and the volume is in the billions. So they do quite well, but it is a flawed way of computing the gains. The other thing they do is the Sharpies. See, I have an account that has about a 5% commission because I'm not. I do it more for entertainment and to win some, etc. But a Sharpie will get an account down to like 1%, and who bets an awful lot. For example, I consulted with a guy in London a few years ago who was betting the races. He had a 1% account. And what Betfair does with these people is it forces them to take some of their profits. So they're doing a bit of that. So they're discouraging the ones who win a lot by taking some of their gains. But they still do fine. But the basic idea is flawed, but they still make huge amounts of gains. Before I forget here, if you go back to racing, I have a new book a year or so ago called Exotic Betting at the Racetrack, which prices all the kind of bets. It has handicapping and actual bets and pricing. That's Exotic Betting at the Racetrack. And I also have a memoir book. If anybody likes travel, I have 100 pages of travel all around the world in a book called Adventures of a Modern Renaissance Academic in Investing and Gambling. And I have all the stories of working with a lot of the greats. I worked with Harry McPike in Nassau, who was a futures trader. I worked with Thorpe. I worked with a crook in the Caribbean, with different people, with Hong Kong people, etc. So there's all the stories there of that, plus travel, plus research, etc. That's Adventures of a Modern Renaissance Academic.
All right. How about lotteries? Some lotteries are beatable.
Lotteries are very, very interesting. I have a very good survey paper called Racetracks and Lotteries, which I will send to you guys. And let me tell you the two things that are in there. The possible, first of all, I was a consultant for many years for the BC Lottery Commission, for the Canadian Sports Pool, and for the Singapore pools. And some of them are sports lotteries and some are regular lotteries. If we stay with the regular lotteries, I have a guidebook called the 649 Guidebook. It's kind of a little yellow thing it's older, 1986, but it still has relevant stuff for now. And that discusses various things on lotteries. Now, unpopular numbers are what you play. So some of the numbers are unpopular because people don't play them. So if you play the unpopular numbers, your advantage goes up. However, it's difficult to win because the advantage is mostly in the bigger prizes, which have low probability of winning. So there. But anyway, there was a group in Florida that won a lottery using my actually best unpopular numbers. The unpopular numbers tend to be the high numbers and the numbers ending in zeros and nines. And the popular numbers, which the prizes are about 1/7 as big with popular numbers, they're things like 33, Marilyn Monroe's birthday, 36, low numbers, etc., 7, etc. The unpopular numbers are like 42, 43, 44, 9, things like that, etc. Now, I was always interested in the concept of buying the pot, buying all the numbers. And in fact, there was a lottery in British Columbia. It was 5 out of 40. And the jackpot was only paid to the 5 out of 5. You had to get 5 correct numbers. But there was no second prize at all. So what happened was nobody was winning this lottery. So over time, the jackpot got higher and higher and higher because people thought it was impossible to win. But it became a tremendous advantage to buy all the numbers. I actually talked to Thorpe about possibly doing it. We didn't do it, but we could have done it. And it was there for 6 weeks. So I was interested in figuring out the mathematics of when does it pay to buy the pot. And I wrote 2 papers with a guy called Stephen Moffat. And Stephen Moffat worked for Susquehanna in the 80s. And Susquehanna were the ones who were getting jackpots all around the world, etc. And so Steve and I figured out the things. And I have 2 papers. I will send you these 2 papers. They were published in the Wilmot magazine. And you can distribute them if you wish. One of them is on 649 directly, and one is on the general case of general lotteries. So I have those two things. Basically, what you want is it's optimal to buy the pot when there's a large pot and not as many people playing it. Okay. Normally, what happens is as the jackpot gets bigger and bigger, more people play, and that's what we have in horse racing, in the jackpots in horse racing now. The so-called rainbow pick 6 is a similar thing to lotteries. Let me just discuss that for a sec. That's a case where, I'm sorry, can I just cover this for just a sec? the regular pick six is hard to win because the prices are high, $1 or $2, and you need a lot of combinations to do it. So what they did is they invented a new thing called the Rainbow. The Rainbow has 20-cent tickets, which means you can buy a lot of tickets. And the thing is, so what happens is part of the prize is carried over when it's not won, and part is paid out to the regular pick six winners. The jackpot is actually the unique pick six, but you don't get the unique pick six very often because with 20-cent tickets, people normally win the pick six. So they become large jackpots. Anyway, I have a discussion of this in the sports analytics book.
You talked about buying the pot, which is theoretically easy to understand, but logistically,
it's hard. It's hard. It's hard to do it. The 5 out of 41, there were 600,000 combinations, and it was doable with the bigger ones and so forth. But there are groups who are trying to do this.
When the lottery started in Illinois, which I'm going back 40 years, I think, there were only 6 million combinations, and the tickets were 50 cents. And it reached a point where there was a big overlay, and I called my father, who was in Chicago, and I explained it to him. He put together a little consortium, and they called the lottery commission and said, "We just want to buy one of every ticket, and just put us down for one of every combination." And the lottery people kind of freaked out, and after some discussion, they basically came back and said, "You have to buy the tickets yourself." And that was, I believe, before the days of quick picks, which means they would have had to have been filled out manually. So obviously it never went anywhere because that would probably be impossible.
Can I give you the one example we did? I consulted for BC a lot. Mainly what I did was to help them fix up games where they made an error. They would design a game and it would have an error in it. And so there was problems with it. So it would fix them. So I knew the people, I knew the director very well, and it was so forth. So they had one case where they had a lot of money on unclaimed tickets. So they decided to have a deal. They would give you a bonus. So they had a lottery with expected value 41 cents per dollar. But for the giveaway, they gave you 6 tickets. So you got 6 tickets for the price of 1, which means instead of having an expected value of 41 cents, it was like $2.40. So you had a big advantage. So the optimal thing there is to buy as many tickets as you possibly can. So a few of us around the university, we bought 13,000 tickets. And that was pretty good because the expected value was we should have basically slightly more than doubled our money. We should have collected about 30,000, and which is what we actually did. So we bought these 13,000 tickets in different places, and it's kind of a big job to look through all the tickets to find the winners. So we did do that. Yeah. So it's possible to do that. Now, there have been groups who basically buy all the tickets. There are combination tickets that you can use those to manufacture a way to cover the board, et cetera. Actually, I worked on the mathematics of that with a guy who was visiting from France. And we have a paper, I never published it actually, about how we could cover the board using these combination tickets. So that's one way to cover the board better. But there's great relationship between horse racing, exotic bets, and lotteries. And in my paper, which I'll send you, I talk about that a lot.
If any of our listeners were interested in doing well in the stock market between now and the end of the year, what would you recommend that they do?
Well, the first thing, fellows, if you want to invite me for another one of these talks for an hour, I can do the stock market because it's a bit complicated. But let me give you the 3-minute answer now. First of all, we went through a difficult period in 2020 with a vicious COVID attack during February to June 2020. That was vicious in the stock market with the volatility going very high and a huge drop and then a huge rally based on two things: very low interest rates and extremely high stimulus. Now, this stimulus is continuing to now is a golden period for trading in the stock market. Ever since July 1 of 2020, it's been a golden period, and it's been very, very easy to do well. Now, we've got a lot of interesting things going in the market. We have a lot of stocks trading for enormous prices based on new people in the market, the so-called Robinhood investors, and who gang up on hedge funds, etc. So anyway, so the basic idea is the market is good now. Inflation is rising around the world. The Fed is eventually going to have to raise interest rates, and that's when you have trouble. But so far, they don't want to raise interest rates. It's hard in the United States to raise interest rates because there is so much debt. So it's going to be hard for that. So they're on a fine line, but it's been a golden stock market, been very, very good at things. For example, I noticed today Moderna is up another $60. My wife bought it at it's $480, and she bought it at like $40 or something. And like Tesla, she bought Tesla at a low price, and it's multiplied like crazy. So there've been a lot of stocks that have really done well. So it's fine. I'm a more conservative investor in a way. I have two sides. I have my gambling side, which does futures and trading because I was running a fund. And then I have my preservation of capital. In my preservation of capital, I have 3 stocks I love. Microsoft, they always make money. Berkshire Hathaway, you have Warren Buffett, very smart guy, and Apple Computer. So those 3 are dynamite, and I'm always playing options on them and long positions, etc. And in the family, we did well with Apple because we started investing in Apple in 1995, I'm sorry. And so the shares we bought then are 25 cents, and the stock is 140 or so. The high one, 140, 148 or so. So I like those 3 stocks. They're solid. They always make money, and they have good management, etc. Now the high flyers, you can look at the COVID type stocks, etc. Oh, I must mention books that I have that you might want to read.
Yeah.
Calendar Anomalies looks at anomalies based on the time of the year. And that book has all sorts of stuff like options expiry, turn of the month, turn of the year, holidays, this kind of stuff. That one's called Calendar Anomalies. and arbitrage. And then I have a book called Stock Market Crashes. And in stock market crashes, we have all sorts of models for predicting crashes. And I watch them all, because who knows what's going to happen now. None of the models are in the danger zone now. But it's very expensive. So when things get very expensive, they can certainly go down. Excuse me, I've got a cough here.
Yeah, bless you.
So sports analytics, I think that's your last question. We cover highlight, basketball, baseball, NFL football, and horse racing. Can I tell you one of the things we have that I like a lot? In the baseball, we ask the following question. If you allow a batter to bat in all 9 positions, who would be the best? And we did a calculation on that. And then we have also an analysis of who had the best seasons. And it turns out of the 10 best seasons ever in baseball, they're all by 3 people. And you can guess who they are. They are, of course, Babe Ruth, Ted Williams, and Barry Bonds. One of my investors was a baseball player who was recruited to be the second baseman of the Boston Red Sox, but didn't want to go. And he was friendly with people like Ted Williams, and he related the following story of Williams. When Williams was retired, he was playing around at the baseball thing, and somebody said, I'm going to put a glove way in the outfield and bet you that if you have 5 swings, you can't hit that glove with the ball that we pitched to you. So anyway, so Williams said, well, I think I can hit that glove. You know, I'm so accurate. Anyway, Williams hit the glove 4 out of 5 times.
Wow.
Wow.
So, you know, so there's some of these guys that are pretty good. And he relates that Bonds was extremely good. I know that Williams was extremely good at not switching at bad pitches. So if the pitch was half an inch outside of the strike zone, he wouldn't swing at it. And there's a nice picture I have of what would his batting average be if the pitcher threw the ball in certain positions. And in the Hall of Fame, there is a display of this. And I put this in my book, Adventures. My Adventures has all sorts of stuff like this in there, and et cetera. And Williams was a great. So anyway, of the greatest hitters of all time, the greatest years were by Bonds, Ruth, and Williams.
We're going to have to cut off the answer to this. We got one more question for you. Now, you have a large number of books that we've talked about. Currently, there's a sale on these books. Tell us about that.
Well, actually, World Scientific has a sale of 40% off at the moment. So you have to buy just 3. I have to tell you my position.
Your new book?
I write the book to understand.
On there?
I'm sorry, what?
Is your new book that is going to be out in a few months, can that be?
Not quite yet. No. The new book is going to take 2 or 3 months to get out. But it's called Sports Analytics. If you look for it around October, November, it should be out then. And we've got a lot of nice stuff in there. We've got a lot of stuff on strategies of the best way to play. Can I tell you one strategy that a colleague of ours put, and we put it paper in the book? You're going for the first down. You're going for the first of all the books are on Amazon, and they're all on World Scientific. World Scientific will give you the better discount, though. So if you go to that, and I sent this to Bob.
Yeah, I've got it. We'll put the link in the show notes. Yeah, we'll put the link in the show notes.
Students, people can do that. they get 40%. The rest of the books are all on Amazon, etc. So there's different things. I have a lot of stuff that's theoretical on portfolio management, futures, etc. Things that you might think about. Great Investment Ideas has all sorts of good stuff in it. The Crash book is wonderful. I like the NFL guidebook if you like football, because we talked about the history of football, plus the batting and all the things. And of course, I like my memoirs one, Adventures, because I've got a lot of nice stuff in there. And I have pictures of around the world, different travel of different places. Let's see, those are some of the main ones. And if you just look under me, I have a website, williamtziemba.com. You can see that. That has stuff.
We'll link to that as well.
And I guess you can put email if you want, if people want to contact, WTZIMI@mac.com. WTZIMI@mac.com. And I like to respond to people. I view myself as a professor educating myself and other people. So I like to have contact with people, and I taught for many years. I still give lectures, and I enjoy that.
Very good.
And the books I enjoy doing, and they have a lot. And I don't mind giving out the ideas of how to do trades in the books. It hasn't affected my trading. I still do the same trades. And the markets are big enough so that there's plenty of room for everybody.
Well, that's great. Thank you. I'm sure you will be hearing from our listeners.
Okay, very good. And do you send around a tape of the interview, or how does that work?
I will send you a link.
That after.
Yeah.
We'll talk about
very
that
good, guys.
Yeah.
Okay, and I have a couple things to send you, so I will try to find them right now. Okay.
Yep.
Okay. We're right now at the end of our show. We have a recommended section. So, Richard, you get to go first. Do you have a recommended for our listeners today?
Yeah, since we were talking about the stock market and stuff, my recommendation is, I've mentioned before a podcast called Planet Money, and currently they are running a series called Summer School, and this is basically the most basic treatment of how to invest in the stock market. You know, for someone who really doesn't know anything about it, this is a rudimentary introduction to the stock market and how to trade. And even if you do know some about it, the episodes are very entertaining. And the second episode in particular has a story in it about Warren Buffett basically calling out hedge fund managers and saying that hedge funds are overpriced and, you shouldn't put your money into these things, and that he was willing to bet that he could outpick a hedge fund, easily. And one of these hedge fund guys took him up on the bet, right? And so in 2007, they bet $1 million that Warren Buffett could outperform him for 10 years. At the end of 10 years, whoever done better would win the $1 million. And so it was the hedge fund, and Warren Buffett picked an S&P Vanguard index fund, which is what both Warren Buffett and Ed Thorpe recommend to the average investor, is to buy an index fund. Anyway, they went 10 years. Warren Buffett won the $1 million bet. The index fund outperformed the hedge fund. So it's a great series. Again, that's a podcast. It's called Planet Money, and they're currently running their summer school.
Very good. My recommend today is about storytelling. I've told you before, Richard and I are into storytelling. Richard actually has 3 links on Facebook on 3 different stories he's told. These are 99-second stories, which are short, of course, but they all have beginning, middle, and end. Richard's happens to be humorous and well delivered, and they're about everyday things. One is about taking a shower, one is about getting a hole in one of his socks, and one is about not cutting his hair during the pandemic. They are delightful. Listen to one or all. I promise you'll enjoy them. Dr. Z, are you still on the line, and do you have a recommendation?
Yeah. Actually, can I go back to Buffett? First of all, Buffett has a 56-year track record, making 20% per year, and he has the S&P gained about 10. So he's about double the S&P over a 56-year period. Now, Thorpe actually convinced me to invest in Berkshire a long time ago, which was a good idea. Thorpe himself invested earlier on as well, and et cetera. And Buffett loses on 1/3 of the months. He doesn't win all the time, but 1/3 of the months he loses, and 2/3 of the months he gains. Now you can see an analysis of the Buffett in Great Investment Ideas. That's my book, Great Investment Ideas. But he's always a good investor. Now with hedge funds, some of them will certainly beat there. I have 2 papers in Great Investment Ideas on evaluating the greatest investors. Who are the greatest investors? Now, I have a model in there where I modify the so-called Sharpe evaluation method. And the bottom line is Buffett improves, and he's a 1. Thorpe was a 13.8. And Renaissance Medallion was a 26.4. So it's possible to be better as well. How did Thorpe do it? Thorpe did it with risk arbitrage, carefully done. How did Renaissance Medallion do it? Hire 100 brilliant mathematicians to create long trades that are 8 seconds and do that. And they do that. So some of the hedge funds can, in fact, beat it. On average, Buffett is right that you'll do better with S&P index fund or better invest in Buffett stock, which is double the S&P over time. So in terms of ideas, I always push my books. I don't make any money on the books. I have to make money trading. But the thing is, I get the pleasure of people using the ideas. So I mentioned a bunch of the books. You can see what you might like. So that's fine. The book that I did with Thorpe, the Handbook of the Kelly Investment Criteria, is the one that actually sells the most. That sells a lot. Part of the reason that it sells a lot is Thorpe got a $500,000 advance for his book, A Man for All Markets, and when he did marketing for that, he pushed the big handbook. So a lot of people get that one, but it's quite good. We've got lovely stuff. We got great reviews. So thank you very much for having me. If you
thank
want
you for
to
being
have
here.
Another one on the stock market, I can do a whole hour on the stock market easily because there's a lot going on. Very good. And I do have models for looking at crashes in the stock market crash book, which I did with a Russian mathematician and a French, another mathematician in France.
Go out and hit lots of royal flushes, everybody. Good day.